Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, June 17th, 2019. I was considering skipping the market wraps, and since there's nothing new to report in the stock market, nor will there probably be anything new to report until Wednesday's close with the big FOMC meeting on deck for Wednesday. The announcement will be at 2 p.m. Eastern Time. So what happens is usually, as I mentioned last week, markets go into a holding pattern before that. So barring any big headlines that can jolt the markets will probably be more of the same. So this is just a quick look at the charts. For those that might wonder about it, I did mention the potential for bull flag patterns back here last week, but those have now been foiled. Why are they foiled? Well, essentially, if you see what you think might look like a bull flag pattern, it's just not, the symmetry isn't there in the pattern at this point in time. Let me grab a highlighting tool here. Let's mark that. So you can see if this would be your flag at this point in time, or bearish pennant, it's nearly half the length, if not more, of the flag pole, and that's just too long. Typical bull flag pattern will look like this. You have a period of consolidation, your flagging action, then you move on up like that. So we're beyond that. Now it doesn't mean we can't go up, but just wanted to make mention that those patterns have been foiled a couple times over so far, with where it looked like the markets were trying to break out, especially back here. I had that on, I think, on the 60-minute chart. Yeah, there it is, 60-minute chart. That was the cleanest looking flag we had right here, and we popped above it, and then just nothing. And that's, again, typical of a market going into a big Fed meeting. They're not all big. Some of the meetings we know offhand, or ahead of time, I should say, that there won't be any changes. But in this one, we have I looked the other day. It doesn't. It's hold on. I'll get it for you. I have it on another monitor here. Looks like a 17.5% chance as of today that we'll get a quarter point hike on Wednesday. I'm sorry. Excuse me, a quarter point cut reduction in the federal funds rate, and an 82.5% probability that we'll have no change. And then there's a much larger probability of the quarter point cut at the next meeting in July. Now, where am I getting at? That's CME Group. They have the Fed funds futures. These are, I got to imagine fairly sophisticated market players if they're buying futures to bet on rate hikes and probabilities. Those are your, institutions, mostly professionals there. So they're usually pretty darn accurate. And the other thing about it, even if they weren't, I know this Fed like the back of my hand. We all know this Fed. No surprises to the market. That Fed is long gone, the one that will surprise the market. This Fed, if they're going to make any shocks beyond what the status quo believes is coming, any big surprises, they will telegraph in advance, and then it won't be a surprise, of course. So that's it. So expect, I have to say, 17 as of today, 17.5% probability. That is almost a 1 out of 5 chance. So it's certainly on the table for this Wednesday, I should say. But again, the odds are against it a little better than 82.5% right now. So maybe that changes. And if it does, if we get the rate hike, we'll see. All I can tell you is I expect a lot of volatility on Wednesday after the meeting, initially after the announcement and the Fed statements. And about the only guarantee that I'll give you is you're going to see a lot of back and forth rips in the market. Any stops that you have close by will probably get taken out. And the usual, when you look at the intraday charts here, let's just go to the intraday charts. I want to show you something. These are just some near-term levels that I shared this morning. Before the or right around a little before the market opened, or right after actually. And that, you can see, this is that sideways grind. What I did here is zoomed into a 5-minute period chart, and you can see for the most part we've just grinded around sideways now for a while here in QQQ. These are the days of the week right here. So it's about 1 week of sideways trading action, and the market's gone pretty much nowhere. And now you'll also note the volume's dropping off. You can see the volume bars down here, and then you can see they've been volume's been tapering off as time goes on. What is that? That's people not wanting to take a position. Why take a new position? Whether you're an active trader, swing trader, or a long-term investor, why buy a stock or an index right before the announcement? Why not wait to see what happens? So that's what happens. You get caught in these little slow grinds when you get right up to the announcement. And again, probably more of the same tomorrow and into Wednesday before the announcement, unless something big hit the headlines. Okay, so to not spend any time talking about the same levels in the market that I've been talking about for last week, since we haven't gone anywhere, let's talk about fundamentals for a second. And a lot of chatter in the trading room today, and most recently somebody asked, well, do you think Powell will say anything remotely hawkish? I doubtful, very doubtful. Of course, here's my point. I think most eyes right now on the market are waiting to read and hear and see what the Fed does and what they say. Again, it's not, well, it will be about, if you had a quarter point cut, that will actually surprise the masses. It's not, it's, one to, chances are, below 20% right now, as I just mentioned. So that in itself would be a surprise and probably gun the market up. But I'll tell you, it can go either way. And here's what I think. I think a lot of investors and traders right now are having a hard time seeing the forest through the trees. There are quite a few, an increasing number of economic indicators rolling over. And this is just one. You can Google search or do a web search on the Morgan Stanley Business Conditions Index, or MSBCI. Here's an article somebody published on MarketWatch. This guy here, I'll give him credit. But you can get this chart again all over the internet. This is the biggest drop that they've had since this indicator has started. It's reached levels not seen since 2008, and this isn't the only one. There's some other indicators rolling over. This one's pretty significant, so it made headlines. Again, sometimes you'll have one indicator that has a blip or a temporary aberration, but one after another I'm seeing a lot of things out there. And again, you can do a search, you'll get it. This is Bloomberg's article here. I might have cut off the top of the page in the video here. Same thing, talking about the a lot of economic data rolling over. We're seeing an uptick in unemployment claims, and now what I wanted to talk to you is about why a rate cut. Everybody, the vast majority or the consensus seems to be that a cut is going to be bullish because it keeps that free money punch bowl going, and as long as that happens, everybody's happy and the market will go up until the Fed stops supporting it. That seems to be the belief. But that's not the facts. When you look back in history, let me grab another chart here. I got a couple going on right now. Okay, so here's one. The blue line here is the federal funds rate. So we're going back all the way to the 60s. The shaded lines right here, sorry, look at these little pop-ups going on, that's annoying, but the shaded lines, as you can see, are the recessions. So what you'll note is, and this is a fact, there's I forget who it was, a well-known economist was quoted as saying, you don't go long the first rate cut, you go long on the last one. Now what does that mean? Well, as you can see here, let's just go back in time. Here's our last recession right there. There's the Great Recession, 2007 to 2009. And you can see that the Fed was raising rates up until there, plateaued, and started hiking if you look close enough. And again, you can go look at this, pull this chart yourself. This is off macrotrends.net. That's what happens. They cut rates right before. So traditionally, you can see it there, you can go back in time. The Fed has started cutting rates after a rate hiking cycle. And don't make no mistake about it, we were coming off a cycle. It's so minuscule because they were coming off near zero, but they've been on a rate hiking cycle for a while. It has plateaued. And so right now, the question is not, are we going to get another rate cut, or what will the next rate move be? Will it be a cut? No. Right now the market is saying we're going to get a rate cut. It's just a matter of, do we get it Wednesday or do we get it in July? That's what the market is saying now. Maybe that changes, but again, do this yourself. Pull any of these charts. You go back in time, historically speaking, and you will see, again, that's that old saying, you want to buy the last rate cut, not the first. This would be, if we get one tomorrow, this week, or next month, or anytime this year, it will be the first cut after a cycle. And again, history shows that shortly, very shortly, with a pretty small lag time, precedes a recession. And this is just another chart. This one's on trading economics. Again, here's the Fed funds rate back 2005. Rate hiking, market was going up. Here's the scaling, or what we're looking at, the Dow and the U.S. Fed funds rate. So just like now, the Fed funds rate plateaued out after a rate hiking cycle, and they started cutting rates, and then boom, that doesn't look like much on the scale, but that's the Great Recession. That's the 50+ % drop in the S&P 500 and the Dow right there. And again, so that's where that was the last cut right there. And that's how that old saying goes. You don't want to buy the first cut, you want to buy the last cut. So that's my point of view. And you can, and the market, now the important thing is how does the market take it? And they may react if we get a rate cut or we get some very dovish statements. The market could very well react bullishly. And again, I'm not talking about this at 2 o'clock exactly. You're going to get whipped to pieces if you try to react to the first reaction from the market, whether it's a rip or a dip. It's going to do this, this, this. Where does it trend after? Where does it open Thursday and continue and close on Thursday? And then usually by the end of Thursday, Friday, and of course then we have a weekend coming up, we'll know by early next week this market will have chosen a direction. Maybe it chooses it right away, but that's something to watch. How does a market react? Not what it should do based on history, because a lot of people come out with the argument, oh, well, this time is different because we're coming off that unprecedented period of quantitative easing and low money rates. And I will say there are and have been a lot of distortions in the market. But I just wanted to kind of impress the point that a rate cut, while most will say that that's going to be bullish, not necessarily. And I just showed you quite a bit of evidence to the contrary. Okay, so where do we go from there? Well, the same levels I've covered for weeks. This is a 60-minute chart. If you want to kind of hone in closely, these are the same levels. I still, barring any brief pops, I'll usually suspend stops on trades that are close to the stops on a FOMC day in case you get whipsaw signals, meaning something like this, an immediate knee-jerk reaction up and a pop down. In fact, I covered that scenario in last week's videos where it's what I call my more bullish of the two scenarios. It's my alternative scenario where the market pops up, makes a marginal new high. I'm talking over these recent highs here, and then puts in a divergent high like this. Right there, you'd see divergence on the indicators, and then we turn around and the market reverses. So that's still my alternative scenario right now, and with a preferred scenario being a resumption of the downtrend that started back in 2018. Or actually, I should say this most recent resumption of the downtrend that started back here in about around early May. And that was actually QQQ we were just looking at. This is SPY right here. SPY again has that 291.40-ish level resistance, and that would, if we get any pop, and it's as long as it's a marginal new high, meant to be a divergence line like that, and then we reverse, that would set up that scenario. And again, these are the swing trading time frames going back for months now. Look for these divergent highs right here, like we had a divergent high on the SPY, and that sets the stage for the next downtrend, the next trade for a downtrend. And then the falling wedge right there, we have a divergent low, had a divergent low that triggered this whole, was the fuel, the technical fuel, the setup for this rally. And so like I said, this would mesh well. You don't always get what you want, but that would be a nice looking setup. And because it would indeed push the upper limits of what I had, as we started this rally, laid out in advance. These were my uppermost bounce targets here, where uppermost, I figured the rally might go up to 289, and as long as it didn't exceed 291.40, I was fine with it, with the short positions. But again, technicals have changed a little bit because this scenario would now set up that nice reversal like that. So that's why I'm giving my positions a little room if we happen to get that pop. But if it doesn't get faded and you continue to build on it, again, everything is dynamic. We'll have to see how things trade. Mostly heading into Thursday. Like I said, whatever happens Wednesday is probably just post FOMC noise, unless you get a really, really big move in one direction or the other. That might give us some clues. And if you do, just watch these resistance levels, and then maybe also zoom out to the more significant daily chart. And I don't want to talk too much on these warning levels here. These are key support levels that if we start to move down and things get going fast, because that's one thing about the market. I'm going to probably wrap up here and just say that just do not underestimate how fast the market can fall. And even these drops, even these what seem like waterfall, and that was a waterfall sell-off. I won't take anything there and there, but that you could see worse. There is a lot of excesses built up in this market, and so that's why I do these videos on a slow day like this. That's why I decided to do this one. Have your ducks in a row. Is a melt-up scenario possible? I'd be a fool to say it's not possible. Anything's possible in the market. That could also, like I talked about before, wouldn't change my longer term outlook. Near term, it certainly would if we go up through those levels. It might be a rally into the next week or two, 3 weeks. But as I said, doing so, just as I said back here in 2018 when we put in this high, I laid out a scenario that the markets will go on later in the year to put on a, if they did break out the new highs, which they did, would be a divergent high, and that's what happened. And these big daily divergent highs are where you get the big moves down. So we did have divergence right here. If we push up again, all it means is we simply extended these existing divergences that were in place, and it only sets the stage for, in my opinion, a much larger drop. So that's it. And yeah, a lot of things will happen. I don't think that's not my preferred scenario, but it's one I'll watch and trade. I'll have to, manage my positions appropriately. If we do go up above those levels, like I said, I'm watching on the 60-minute chart, and if we reverse down, then I'm currently positioned as the trade that we put on a few trades recently, including a QQQ short trade on the site and some other things. And unlike this drop, we also had a QQQ short trade right here, first one in months, and it was not. We were trying to hit a let's say a single or double, and that's what we did. We didn't catch the entire move down, but we caught a good deal of it, and then got out of that. Got long and bullish here, and for the bounce. And my point is, I'm looking now. I was looking for this to be the initial wave down, followed by a counter trend bounce, and then a much bigger wave down. So I can tell you that the shorts I have now, a lot of those are not for 3-4% pullback trades with move up to new highs. Those I'm going to let run. So I just wanted to make that clear, that if we start to move down Wednesday, and this is just me, what I'm doing, I'm not looking to grab, cover some shorts on the first 2-3% drop in the market, 4 or 5 even. I'm looking for a move that's probably going to come on down, and at least down here to this minimum target on SPY, even though I'm not short the SPY, I'm short QQQ and some other things there. But you can see some support zones, and then these are the levels where if we start moving very fast, these are the levels that could open the door to a much bigger sell-off. All right, so let's wrap it up here, and like I said, one day at a time. Tomorrow will probably be another go nowhere day, and most of Wednesday again, unless something big comes out, some trade deal on China, or some other tweet or headline that could move the markets. But barring that, you can't always trade around those things. Can come out of anywhere at any time. I think the big moves will happen on Wednesday afternoon and into Thursday and Friday, and probably going into next week as well. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.